Good afternoon, everyone. Welcome to this week's webinar masterclass. My name's Sophie. I'm the Community Membership Manager here at Enterprise Nation. And today we are delighted to be welcoming Simon Kallu from SRK Accounting, who's going to be talking to us all about how to set up and register a new business. So if you have any questions for Simon throughout, please do type them into the question box provided, and I'll be keeping track of those for a Q&A at the end. So welcome, Simon.
Thank you very much, and hello to everyone. Thanks for joining us. As Sophie said, I'm going to take you through, I'll just move on, initial business setup, structure and considerations, and try and keep this as light as possible and focus on what I see as the most important areas, so you can get good value and take away actions from this session. And then also we've got a bit of an offer for you guys, so you can get more information as a follow-up. So if I show you the next slide, the webinar inclusions, and we're actually picking up key points from a book that I've written. It's not out yet. I'm just finishing the editing side. And there are sort of 15 key points in the chapter which is actually on this particular topic. So I've picked out the top factors, so in consideration of time on the webinar today. So I'll go through those, and those are the items that are highlighted in black. So the first area I'm going to talk about is, why do you really need to consider this area? It's not the sexiest of topics. Should I just get started? Should I just get going and worry about the structure later on? So we'll talk about why it's important to think about it now and what the advantages and disadvantages are of doing and not doing that. Are you clear on the positive and negatives of each structure? So that's really around trying to demystify things and simplify things so that you can make an easy decision. What is our recommended solution? Where would you go to set up the solution? So I'm not too sure the spectrum of guys and girls that we've got on the call today. So whether you've got a business already in operation and you're just thinking about whether the structure is correct, or you've got an idea and you're planning for the future. So it will depend on your current stage and situation, where you go, or if you've already been somewhere where you could go to review how your setup sits at the moment. And what are your accounting requirements? So accounting and tax deadlines, any other implications or any other thoughts that you should go through. And then the most important bit, so you're all set up, you're aware of your accounting and tax considerations. So how do you get paid? How do you send out your first invoice? How do you get money into the bank? And how do you pay yourself in the most tax efficient way? So as Sophie said, if you've got questions, then sort of fire those through and she'll pass them over to me as we go along, and we'll cover those at the end. So the first thing is choosing a structure, and apologies, my slides are a bit boring. There's no funny images or jokes coming your way, just to pre-warn you. I tried to keep it really content rich, given the time. So why do you need all of this boring stuff? Can I just get started straight away? So it's easier to do it now. If you do it later on, you will find that it's much more costly to unravel structural issues and structural mistakes that you've made on day one, a year or 2 years down the line. It makes your business and your structure future-proof. So let's just say it's you in the business right now, but actually in a year's time you want to bring in a business partner. You want to move into different markets. Actually, you're doing way more in terms of sales and profits than you originally thought. Thinking about those potentials and future-proofing your business now in the structure that you set up will save you a lot of headache later down the line. The best way to pick the right structure then for your goals is to think about your plan. Start to think about, I'm sure you've already got business plans, whether they're one-page plans, they're detailed plans, but start to think about your long-term objectives and what your business looks like in the next 5 years. Who is going to be involved in that business? And would you want them to be directors, company secretaries? Do you want them to have shares? Do you need to bring in people? Do you need to bring people into the business, and do you potentially need to take people out of the business? And will they want a share of the profits, or would they be happy with just a salary? So people now, and much more so in the future, are entrepreneurial, and how do you protect your workforce, keep them within your business, and prevent them from moving off and doing it on their own? And what will you potentially earn? What will be the size of your business in the first year right through to the 5th year? So if you list out these answers, or answers to those questions, and then the next sections will help us be guided to the right choice. So are you clear on the positives and negatives of each structure? So a limited company is the most popular option for startups, and actually one of the most popular sort of blog posts and videos that we've got on YouTube is the difference between limited sole trader and limited liability partnership. And people still don't really understand why and when you would choose to stay as a sole trader, move to a limited company, and what a partnership is. So a limited company is the most popular option. The main benefits are it's a separate legal entity which eliminates personal liability, and money that's distributed via profits is only taxed when you receive it. So if you leave your profits within the company, yes, it will get taxed to corporate tax at 20%, but it will not get taxed to income tax again unless you decide to take that money out of the business. So it gives you tax planning opportunities. Compare that to a sole trader. Taxes are delivered on income that is received. So as profits arise, they will get taxed. If you enter into any contractual agreements, they're essentially with you and not with your company. There's no separation from a legal perspective. You can't bring in shareholders, do tax planning, or limit your liability. And the only real advantage is cost. So I probably should have said this at the start, but I will distribute the detailed notes for this, but if you've got a pen and paper and you can sort of scribble down notes as we go along, I think that would be advantageous, because I am going to talk quite a lot. The only real advantage is cost, but we would not recommend being a sole trader in any instance really, unless you're working as what I would call a side hustle. So you're selling things on eBay, you've got a small separate business, and your earnings are under about £10,000. Once you start to go over £10,000 in terms of profit, it's about 25,000 in terms of sales. If you think you're going to go over that, I would set the limited company up now. That's our recommendation. Limited liability partnerships are complicated, but they can be massively beneficial in certain circumstances. So for example, a company like KPMG, multinational or sort of international accounting and advisory firm, they need to run a structure where partners can take part in a profit share. It motivates them to own their own businesses within the larger organization. But if they have a standard limited company where they brought in new partners, and partners were to leave, it would trigger really complex share movements, and evaluation of the company would need to be done every single time a partner comes in and out. And that's just not viable. So that's the main reason for these larger organizations using this structure. So moving on, what is our recommended solution? So our recommended solution, and this webinar and also the book is written primarily for owners of owner-managed businesses, so not necessarily venture-backed businesses, although it's still applicable. Entrepreneurs who want to grow their businesses and achieve success on their terms. So for 99.9% of these people, this does mean earning over £25,000, which is our sort of benchmark for registering a limited company. So a sole trader, in my opinion, is too restrictive in tax planning options. It doesn't reduce legal risk, and it creates the perception, or can create the perception to the outside world, that you're a small organization. Therefore, we would recommend a limited company, with a limited liability partnership being only relevant to those that are planning to open a legal practice or a business where partners are likely to come and go. In a limited company, You limit your personal liability. You place less risk on yourself and your family. You and the company are different things, and you're effectively an employee of your own company. And yeah, you do have an increased responsibility to act appropriately, but you can get great information from the Institute of Chartered Directors on the basic responsibilities, or you can literally go to Google and say, look, what are the responsibilities of a director? If you're our client, you can talk to us, and they're basic and they're simple, and there's nothing to really worry about. And people tend to worry about a limited company versus a sole trader, but actually it's much of a muchness. Where do you go to set up this solution? So pretty obviously I'm going to say go to your accountant. It doesn't have to be us, but go to a reputable chartered accountant to do it. And the reason for this is, yes, you would save money by doing it yourself. Yes, you can go and register your company for £17.99, but you really need to consult with someone outside of the business on your future plans and have them have a look at a standard share structure and whether that needs to be changed for your own goals, what legal documentation needs to go along with the company to make it as easy as possible for you in the future to move things around. You're going to need a bank account. So for a limited company, you need to have a separate bank account in the company's name. Even if you're going to stay sole trader, I would recommend having a separate bank account. It just makes it easier to track transactions. So most of the high street banks offer similar functionality in banking, but they do have different strengths and weaknesses. So don't just bank. This is a good thing to think about. Don't just bank with who you bank with personally. Have conversations with all of the big banks and pick the one that sort of fits your business the best. You know, HSBC are great for the technology and international solutions. Barclays have probably the best mobile app. NatWest are really good for smaller businesses, and they tend to be open to talking to you about loan requirements. So speak to all of them and make your own choice. And we are offering, if you get in touch with us and you do want to do a company registration, that we'll do a free consultation with you and a free company setup. So just get in touch with us and we can talk to you about that. And what are your accounting requirements? So generally speaking, you can decide your accounting and tax requirements based on your predicted income, your costs, and your profits over a financial year. So every limited company must pay corporate tax on its profits 9 months after your year end. So if you set a company up today, it would be approximately 21 months until you had to pay any tax. So if you're currently a sole trader and you switched to a limited company, it's actually a really good way of deferring the tax that you would have to pay. VAT is a tax that's applied to all sales if you're registered or you're over the threshold, which is about £80,000. And it can be charged to you on purchases. So under a normal VAT scheme, you would calculate the VAT due on sales. That would be paid to HMRC. And the VAT that's been charged to you on purchases, you would reclaim. And your payment would be the difference between the two. So one area that lots of people miss, I was just speaking to someone this morning whose accountant had set them up in a normal VAT scheme, and they actually would have been way better on something called a flat rate scheme. That's where you can charge VAT to your clients. So if your clients are VAT registered, it's worth registering for VAT even if you're under the threshold. So the reason being is if you invoice a client £10,000 and you put £2,000 of VAT on that invoice, you will only have to pay the VAT over to HMRC at about 11 or 12%. So you make a profit on the difference in simple terms. And yes, this assumes that you haven't got a massive amount of purchase VAT, but in most cases for startups, especially in service businesses, it's a really good way to make money from the taxman, which is great. For obvious reasons. And you need a PAYE scheme to pay yourself effectively. So register yourself for PAYE and talk to your accountant about understanding the implications of paying yourself at different levels and the deadlines for those taxes. So again, we'll send through these notes, but corporate tax is 9 months after your year end, and this is all assuming that you're using a limited company structure. VAT is due quarterly. with a payment up to 45 days after the quarter end. A good tip for VAT is set up the direct debit, and that gives you an extra between 3 to 5 working days to pay, and you don't have to remember to do the bank transfer. So that's a really good tip. PAYE, the taxes on payroll are due the 19th following the month when the salary was paid. And personal tax, the tax year runs separate to your company year end. So for me personally, I would try and set your company year end to be the end of March, regardless of when you set the company up. And that means that ongoing, the first day of your financial year will be 1st of April, the end will be end of March, and what you pay yourself from your company within that period will directly get copied and pasted into your personal tax return. What we see a lot is that people have different year ends to the end of March, which is fine. But some people struggle to understand the difference between what's been paid in a company year and what's going to get taxed from a personal perspective. So just have a think about that. Top tip would be to make yourself a calendar. Once you know your company details, set reminders up, get it into your calendar, get the reminder set up, and you can't forget. Set up the direct debit for VAT and even PAYE. And use a simple system to estimate the tax as it builds up. I would personally set up a second business bank account so that you can move your money for tax into that savings account. You'll never have the situation where you can't pay your tax bill, and you won't start to think of the money in your main bank account being your money, because it isn't. It's the tax man's effectively. Try and get a bank savings account that will earn you interest. There are different accounts that can give you up to actually 6.5% interest at the moment, believe it or not. And it's your responsibility as a business owner to manage the cash flow. So that's a simple and easy way to make sure you don't run out of money. So how do you pay yourself? The first bit really is there are 2 ways to get paid. You can pay yourself through salary or dividend. And we would say that it depends on everyone's personal structure and personal circumstance, but generally speaking, it's best to pay a minimal salary. So at the moment, that's £680 per director. That will give you full state pension credit. What that means is, when you come to draw down the national state pension, assuming it's still there, you will have full credit even though you've only paid £680 to yourself per month. There's no tax implication of paying that salary, and then you can top up that salary with a dividend. So let's say you personally needed to earn £3,000 per month. You'd pay £680 as a standing bank transfer every month, and you top up the difference with a second bank transfer, which you'd call dividend. And that will allow you to operate at the lowest possible tax threshold to save as much tax as possible. Unfortunately, in the last tax year, we used to be able to pay ourselves around 42,000 at that level with dividends and salary, and there'd be no personal tax. Now the tax bill up to about £40,000 of income is around £2,000 of income tax, and it's going up again next year. So there will come a point when it's the same tax to pay full salary versus full dividend, and there's a lot of information online and it's very confusing. The main thing to take away is, even if the tax rates become exactly the same, you're always going to have to pay employers national insurance on a salary, which you don't have to pay on a dividend. So it's almost always in the future going to be cheaper to pay a dividend for the business. The only things to think about there are, if you're in technology or you think you're developing new systems or new processes and there might be a way to do a research and development tax claim, dividends do not count towards the R&D tax claim. So it's really important to do an R&D sort of scoping exercise up front. Even if you are a marketing agency or a creative designer or whatever it might be, the strangest things now qualify for R&D, even if it's a process by which you come up with a new brand identity, for example, for your clients. So it's worth doing that because you'd want to then switch away from dividends and switch back up to salary. So hopefully that makes sense. The easiest way to understand dividends is that they come out of profits that you earn. So let's assume that everyone on the call is sort of a startup or a scale-up business. If you haven't got profits in your business, you can't pay a dividend, but you can still put through a salary. And even if there isn't the cash to pay the salary in the current month, you can pay it in future months. So you have to have profits in your business to pay a dividend. And simply speaking, if you made £5,000 of profit, you'd have £1,000 of corporate tax at 20%. So you could pay out a £4,000 dividend. So you've always got to think about saving that tax and putting that into your savings account before you pay a dividend. So I've tried to sort of skim through that so we've got lots of time for coverage and Q&A. This is an offer for you guys. If you go to srkaccounting.com/unleash, just fill out the details there. We promise not to spam you at all. You'll just be put on the list for the book when it's edited and it comes through, but straight away I'll send you the full chapter of the book, which covers all of the sections, so all of the 15 sections on setting up a business, structure. It gives you a calendar of all the tax and accounting deadlines, and it's got all of the notes that I've been kind of reading from for the webinar. So I'd recommend going to that. That's srkaccounting.com/unleash, and then get a free chapter of the book. And that's Q&A time.
Great, thank you, Simon. So yeah, if anyone has any more questions, please do type them into the question box and I'll try and get through as many of them as I can now. So we have a question here from someone who is concerned about setting up a limited company whilst still in work. Does setting up a limited company whilst you're still in employment affect the tax taken from your salary by the employer? And is that the same when you aren't actually trading yet?
Yeah, it's a really good question. I think it would if you paid yourself from that company. So I would need to understand whether, let's talk about the two scenarios so you don't have to ask the question again. If you don't need to pay yourself from the company, I would set up the limited company. I would keep the profits within the company until you either decide to stop that employment or you need to pay yourself. And then if you're already getting a salary and that salary is more than the £680 a month over the year, I would just pay yourself in dividends from that company, and then it will not affect your interaction with your existing employment at all. And that's how you'd get around it.
That's great, thank you. Question here from someone who is just setting up a company and is going to see their accountant for the first time. They would like to know what you need to do to prepare and what documents you should bring with you.
Well, if we have an initial kickoff session, it's usually built around understanding the goals of the client. So if you've got paperwork and you've already set up a company, you've had letters come through from HMRC, etc., I would definitely take pictures of those, email them ahead of time to your accountant so they've got a full picture of what's going on. And I would look to think about what you're trying to achieve with the business. So you've already had a think about that when that question comes, which it should do. And then you can have more of a meaningful conversation. I think about, what are you looking to get out of the relationship, so you can make sure that that's covered so they understand what sort of success is to you, so that they can add the most value. That's really important. In terms of prepping on an admin side, I would literally just take any documentation that you've got, scan it, email it ahead of time. The biggest thing is going to be thinking about what you want from them. Where's the value? What are you trying to achieve in the business? Maybe thinking about sketching out what the next 5 years would look like in an ideal world, so that you can sit down with them and they can actually be in a much better place to try and help you achieve those goals. So if you're trying to grow revenue by X amount, they will have an input on how you can do that. If you're generating profits, it will help them think about how they can bring in tax strategies to mitigate those profits. So those would be the two areas that I would personally focus on.
Thank you. A question here, if you're paying yourself through the company, how do you process tax? And if it is paid through the company, do you need to do a personal tax return?
Good question. Every limited company director by law needs to do a personal tax return, whether there's payment in salary or dividend or not. It's a legal requirement. And so effectively you need to operate a payroll scheme. So if you've got cloud accounting software, so QuickBooks or Xero, that, you know, you can do the payroll yourself in there. Prep your pay slips and then submit the information on a monthly basis to HMRC. My team do the payroll, so I'm not 100% familiar with when the submissions go, but my understanding is that if you're paying at that £680 level, the low director level, you only need to do an annual submission to HMRC. And then that means you've got all your bases covered. At the end of the year, you need to do an extra close-off year submission. So you could do that yourself. And sorry, Sophie, what was the second part of the question?
I think you've actually covered it.
Okay, cool. All right, cool.
So we have a question here. When you're registering your business, where do you suggest using as the address? Can you use your home address, or does that have any implications?
So from an accountant's answer, you know, yeah, you can use any address. That's absolutely fine. But from a business owner's, from an entrepreneurial perspective, I wouldn't recommend using your home address. I mean, the reason being is whenever I'm looking at entering into a supplier relationship, whenever I'm doing due diligence on clients, I'll always Google them. And if their company address comes up, Google Maps is going to come up. Google Maps has instantly got Street View, and then people are going to look at the front of your house. So I'm not that comfortable with that. It doesn't look that professional. I would personally look to, if you want to keep the cost absolutely minimal, see if your accountant offers it as part of their service. So for us, I mean, we're in a WeWork space, which is a co-working space. Although we've got a private office, we don't offer that as a service, but we have thought about that. So we did a joint venture arrangement with another company that I think for £40 a year you can use their address, and that is a proper office. It's in W1. It's a nice postcode. So I would personally spend a little bit of money and get a registered office address, or if you're part of a co-working organisation, see if you can register the company there. But I definitely wouldn't personally use your home.
Thank you. I think we've got time for one more question here. This person would like to know, when you pay yourself a dividend, do you have to wait until the end of the year?
You don't. And I sat down with a client actually who had been writing dividend vouchers on a Word document every month. They've been paying monthly dividends, which is great. That's a step in the right direction. But they've been literally writing out a Word document every month and having a board meeting to approve the dividends. I mean, it's the difference, I guess, between what's written that you're supposed to kind of do and what practically the reality is around understanding the laws and regulations. So I wouldn't recommend doing dividend vouchers, having board meetings. I wouldn't recommend paying dividends more than monthly, just because it's important to get into the process of having a look at the performance of the business over that month versus your goals, how much cash is in the business and profitability, decide on a dividend. So if it's a regular amount each month, have you hit your revenue and profit goals? Should you be paying that regular amount, or can you pay a larger amount of dividends? So go through that thought process first, but you can definitely pay them on a monthly basis, and you can apply a simple calculation. We've got it in the book chapter. Understand what your profit is, have a quick look at your balance sheet, multiply it by this percentage, and it will tell you what the maximum dividend is you can pay. But yeah, definitely don't need to do it annually. Otherwise, it would be a bit of a problem trying to live for most people on £680 a month. So that's hopefully good news.
Great, thank you. So that's all we've got time for today. Thank you everyone for listening in. Next week we have a webinar all about how to showcase your local business online and make more sales. So I hope some of you will be able to join us for that. And thank you so much, Simon, for joining us today.
Thanks a lot, guys. Thanks for attending. Absolute pleasure. And if I can do anything else, then just get in touch.